China's stance remains unwavering, and the FX market is taking notice. The trade war tensions are back in full swing, with China showing no signs of backing down. Let's dive into the latest developments and their impact on currencies. The USD is facing a tricky situation. While the recent tariff de-escalation provided some relief, concerns have resurfaced overnight. China's response to the U.S. investigation into its trade practices has been firm, with the Ministry of Commerce declaring their commitment to the trade war. Secretary Scott Bessent's comments in an FT interview further fueled a fire, suggesting China aims to bring others down. The FX market's reaction is evident, with safe haven currencies like JPY, CHF, and EUR gaining ground against the dollar. The highly sensitive AUD and NZD, closely tied to China's economic health, are taking a hit. Our baseline forecast suggests an extension of the tariff truce on November 1st is more probable than a full-blown trade war. However, the risks are high, and China's strong export diversification gives them leverage. In a scenario of further escalation, the dollar could face downward pressure, but its renewed safe haven status and expectations of a U.S. retreat might shift focus to treasuries. If market nerves ease regarding Japan's political situation, the undervalued JPY could benefit significantly. U.S. markets resume full trading today, but the shutdown persists. Data releases will have a magnified impact, especially the NFIB small business surveys. Any correction in this series could spark a market reaction. On the Fed front, Chair Powell discusses the economic outlook and monetary policy today. With no fresh jobs data, he may maintain his cautious narrative. The dollar faces some upside risks amid the data silence. As outlined in our monthly FX update, we don't anticipate an extended USD comeback. Once data resumes, we expect employment data to drive the dollar back to October levels and potentially lower by year-end. This week may offer limited direction, but near-term bullish dollar momentum is likely. Francesco Pesole. The euro's path is closely tied to French politics. Until we get clarity, a rebound seems unlikely. Today, PM Le Cornu addresses Parliament, followed by a budget proposal tomorrow. This proposal will determine his survival in a no-confidence vote expected on Thursday. Another government collapse could hinder the euro's gains from the U.S.-China trade spat. If tariffs de-escalate, Euro-USD could target 1.150. In Germany, the ZW survey is expected to show some improvement, but it's unlikely to move the euro significantly. Francesco Pesoli. The GBP's jobs data was slightly dovish. Private sector wage growth, a key BOE metric, fell short of expectations at 4.4% year-over-year. The past 3 months have been consistently benign, with the 3-month annualized rate at 2.4%. We expect a drop to 3.7% by December, matching the BOE's forecast. This would ease concerns about inflation risks. Public sector pay was high in the latest month, but this reflects the current fiscal stance. The upcoming budget should clarify that this won't continue next year. Unemployment nudged higher, but data quality issues persist. The trend aligns with payroll data, indicating a cooling labor market and ongoing wage moderation. A November BOE cut is unlikely, but December, post-autumn budget, is more probable. Our forecast points to a February cut, allowing the bank to assess inflation and jobs data. Pricing for a December cut increased, and GBP swap rates dropped after this morning's release. Euro GBP rallied above 0.870, but further gains may be hindered by French political noise. Francesco Pesoli. In the CEE region, Romania's inflation figures surprised with a slight decrease, remaining at 9.9% year-over-year. Food prices provided some relief. Services inflation remains resilient, and wage growth below 5.0% drags on demand. Our projections are 9.6% for 2025 and 4.5% for 2026. This could allow the National Bank of Romania to cut rates in May next year. Today's calendar is light, and attention shifts to the IMF meeting with CEE speakers. the markets return to full trading mode and the resilience of the USD suggests downward pressure on CEE currencies. However, policymakers' statements in Washington may set the tone. Chris Turner.